Hey everyone, let's talk about something big. JPMorgan just took Goldilocks off the table. This isn't some minor change or tiny tweak to a spreadsheet buried on page 47 of some Wall Street outlook. This is one of the biggest banks in the world saying Goldilocks has left the building because it is now more concerned about a negative growth shock. A negative growth shock that shows, at least for JPMorgan, that something big has changed. And the key point is this: the economy didn't suddenly become fragile this past week. The labor market was already in trouble. And as a result, consumers were already having big problems. They were already stretched. Businesses were already cutting back. Hiring had disappeared. Even the establishment survey dropped to basically zero last year. And that is exactly why the SAM rule warning announced it mattered that much. Remember, the SAM rule that, along with Japanese carry traders that came up at exactly the same time, they both warned you about what was coming. Now, the mainstream spent months saying, no, don't worry about it. The unemployment rate was just normalizing. The labor market was just coming back into better balance. The economy was still resilient. Powell said Goldilocks was still alive and well, except it was never Goldilocks to begin with. And so now JPMorgan is worried about a negative growth shock. But that shock is not coming out of nowhere. It is the next stage of a problem that showed up very clearly in and Claudius's rule simply told everyone what they did not want to hear. That recession warning wasn't wrong. It just showed up where no one was looking. So, let's break this down into three parts. First, what it means when JPMorgan says Goldilocks is leaving the building and why this phrase negative growth shock is something that really matters. Second, why the economy is in no position to absorb any kind of shock because consumers and businesses were already under pressure long before this latest Wall Street downgrade. And third, the big one, why the CM rule inflection was such a major warning, why it got dismissed, and why the labor market has been the real story the entire time. The problem was that everyone kept mistaking the stock market, the official unemployment rate, and a few headline payroll numbers for the actual economy. And now Goldilocks isn't just gone. She has got no way to come back now, according to the report. JPMorgan is no longer comfortable with the Goldilocks setup. That setup was, according to JPMorgan, quite simple. Growth slows, but not too much. Inflation cools, but not because demand collapses. The labor market softens, but it doesn't break. Corporate profits hold up, so does the stock market. The Fed eventually cuts rates. Stocks keep levitating. Everyone gets to pretend the business cycle has been repealed. That was Goldilocks. Not too hot, not too cold, just perfect and right to continue buying risky assets. But now JPMorgan is talking about the risk of a negative growth shock. And that is the entire ballgame because a negative growth shock is not growth that slows from great to good. It is not that consumers rotate from goods to services, like we kept hearing. It is not temporary uncertainty. It means the downside is moving from theoretical to visible. It means the economy may not be gently cooling. It may already be rolling over. And this is where the timing gets important. JPMorgan is not discovering an economy that was healthy yesterday and weak today. Wall Street is merely catching up to a deterioration that has been building all this time. It is the same pattern we've seen again and again. First, the data starts to wobble. Then consumers start telling surveys that something big is wrong. Then companies start talking about challenging conditions. Then hiring slows down. Job openings disappear. Quit rates fall. The unemployment starts to move. And then everyone at least tries to explain it away. And only after the evidence piles up high enough that even Wall Street can't step over it anymore does the official narrative finally change. That is what Goldilocks is leaving the building really means. It means the narrative is being revised long after the economy had already shifted. And the reason why JPMorgan's shift matters, because it finally admits what we've been saying all this time. Fragile, not strong, and resilient. The energy shock takes place. Yes, but the energy shock in the historical context is the marriage between that shock and a fragile economy that simply cannot afford to pay for it. Consumers weren't sitting there with massive excess savings and secure jobs just waiting to absorb higher prices and energy costs and the even weaker labor market. They were already stretched. We've heard it from fast food companies and retailers. We've heard it from appliance makers, packaged food companies, management teams. They keep reaching for polite language, challenging consumer environment and affordability pressures or value-seeking behavior. Because CEOs generally don't go on earnings calls and say, our customers are broke. But that is increasingly what the language means, and that is why the Goldilocks story was always so fragile. It depended on the idea that consumers could keep spending despite a labor market that was already cooling, and despite incomes that were not keeping up with the real cost of living for most, the vast majority of households. That is not Goldilocks. That is a pressure cooker. The stock market may be pricing perfection, but the household economy was pricing survival. And there is a massive difference between those two things. And that has been the real story the entire time. The survival, the lack of income, the lack of jobs, Increasingly lack of jobs, flat beverage, not the first Friday in every month, and what the payroll report might say at least today. Before it gets revised, the real story has always been in the jobs market. And when you look at it broadly, the picture has been deteriorating since outstanding RCC job openings declined, quits declined, hiring disappeared, full employment came under pressure. The household survey showed very serious weakness. Labor force participation, very important, stopped improving. Continuing jobless claims were elevated. Challenger layoff announcements kept reminding everyone that companies were no longer in expansion mode. And even when the establishment survey printed a positive number, the internals were often nowhere near as strong as the headline suggested. It doesn't always start or end with mass layoffs. Sometimes it starts with no hiring, then fewer hours, then fewer quits, fewer opportunities, then people who lose jobs take longer to find new ones, then new entrants can't get a foothold, youth unemployment skyrockets, then discouraged workers stop looking. The unemployment rate doesn't rise as much as it should because people are disappearing from the official labor force. That is the kind of labor market where the official unemployment rate can look perfectly stable while the actual unemployment situation gets to be worse and worse and worse. This is the very essence of what flat beverage means in practical terms. And that is exactly the environment in which a negative growth shock becomes dangerous. Because if the labor market was already fragile before the shock, then the shock doesn't create the problem, it exposes it. Now, let's get to the key piece of evidence here. The SAM rule, which is not really the SAM rule. She took it from other people who had previously looked into the labor market, and it is really about momentum in unemployment, how that is captured in changes in the unemployment rate itself. The rule is very simple. Again, the unemployment rate on a 3-month average basis and compared to the low from the previous 12 months, when that gap rises by half a percentage point or more, historically, that has been a recession signal. It is not magic, it is not complicated. It is basically, as I said, a momentum gauge for the overall labor market. When unemployment starts rising quickly enough, it usually doesn't stop on its own. The labor market shifts, the business cycle turns. What looks like a mild increase becomes something much larger because weakness feeds on itself. And in Nansenarse, the SAM rule did indeed trigger. It jumped past Inderwu and had everyone talking about it. And importantly, the Japanese started trading out. And both of those taken together especially should have been treated as a major warning. But the Fed said the labor market, it is just normalizing. Economists said, the rise in unemployment was not recessionary. The mainstream said immigration and labor supply were distorting the numbers. Others said it was just natural cooling that everyone wanted after the so-called red hot labor market of Arshi and Arshar. Even Claudia S. herself spent time downplaying the signal that was attached to her own name. But the rule was not supposed to be a vibe check. It was supposed to tell you when the labor market and its momentum had shifted too far in the wrong direction. And that is exactly what happened. The problem was that everyone expected the confirmation to come from the same place. A continued rise in the official UFA unemployment rate, but that is not what we got. Instead, the confirmation showed up all across the rest of the labor market. And if you weren't looking, you missed it. It showed up in the household survey. It showed up especially in labor force dropouts. It showed up in jolts. It showed up in reduced turnover. It showed up in consumer pessimism. It showed up in businesses becoming more cautious. It showed up in markets that were already pricing a darker growth outlook. Yes, the bond market, the yield curve, bulls steepening, the SAM rule wasn't wrong. The interpretation of it was. So here's the trap. Most people assume, because understandably they've been told this repeatedly, that if unemployment is a problem, it'll go up in a straight line and everyone will see it. And that is only true if the official unemployment rate is the only measure of that issue. If that is the only measure of that problem, if the official unemployment rate misses the boat, then depending upon the official unemployment rate for confirmation of everything will have you missing what is really important. Because the unemployment rate, the official one, is not a complete measure of labor market health. It is a ratio that is based on who is counted in the labor force. If people stop looking for work, they are no longer officially unemployed. They disappear from the denominator and the numerator in that ratio. That means the unemployment rate can understate weakness when labor force participation falls, when discouraged workers leave the job market. Now, we saw this big time after Downsenimba. The official unemployment rate turned horrible, but even that understated the real damage. Because millions of workers dropped out of the labor force entirely, participation collapsed and never came back. And a lot of those workers, that is why they never came back. There were no jobs for them to find. And that was one of the defining features of the silent depression after the global not financial crisis. And while today is nowhere near a carbon copy of Downsenimba, that pattern matters because it establishes what we should be looking for. When the SAM rule triggered in RC, the assumption was that the UFA rate, the official unemployment rate, had to keep surging for the signal to become valid. But But if workers responded to the weak labor market by leaving the labor force like they did in Ba, and afterward the UFA rate may flatten even while underlying conditions continue to degrade and deteriorate. That is why looking at only the official unemployment rate was such a serious mistake. The labor market was telling a much broader story, and that story was that Goldilocks had already left the scene years ago. But now we're talking about a negative growth shock. No, a negative growth shock is never good under any circumstances, but it is doubly not good when you already have a fragile situation in the labor market that looks like the one that we've got here in Ardinardil. If consumers had strong real income growth, plentiful job opportunities, falling living costs, then maybe, just maybe, they could absorb a shock. If businesses were expanding their payrolls aggressively and competing for workers, then possibly the labor market could take the hit without cracking. But that is not where we are. We're in an economy where many consumers are already trading down, they're already cutting back, they're leaning harder and harder on credit. We're in an economy where employers have already become more cautious. We're in a situation where young workers look at the housing market, wages, debt, job prospects, and conclude the entire system is rigged against them. It is not some abstract political issue. This is basic small economics. When people can't afford the basics, they change their behavior, they skip purchases, delay plans, they reduce discretionary spending, they become more sensitive to job insecurity. And once enough people do the same thing, the slowdown starts to become really self-reinforcing. Businesses see that weaker demand, they cut costs even further. And that cutting cost often means less hiring, fewer hours, more layoffs, which also hits incomes. Lower incomes hits spending, lower spending hits revenue, then businesses cut more. It is the negative growth loop, and we've been talking about it ever since Ardinarc. And that is why Goldilocks is leaving the building is such a big admission, because Goldilocks required that loop to have never started. And now JPMorgan is saying, well, you know what, and this is one of the most important points. Consumers, American consumers themselves saw this before anyone else did other than maybe the Japanese carry traders. U.S. consumers are far better at economics, small economics, than every PhD economist, capital E, out there. They may not use terms like SAM rule or beverage curve or any of the other ones that we talk about here, but they know what is going on deep down. They can see what is taking place. They knew the job market was bad. They knew the wages weren't going to stretch far enough. They knew job postings were fake, that their interviews were going to go nowhere. Hours were going to get cut, and the only jobs that were available only paid less than the bills that they had. This is why sentiment has been so ugly, and why sentiment is tied and correlates really strongly with these labor market shifts. Look at what happened since Ardinarc economists kept asking why consumers were so negative when GDP was positive, and the stock market kept setting record highs.